Hey, it's Soleil, and this is episode 120 of the Orange Pill Investor. And today I want to talk about maximizing efficiency, selling options. Discussed days to expiration previously, and for me, I guess I'm a disciple of the Tasty Trade videos, and for them, 45 days is the optimal expiration. Oh, that means that the market is open, so this will be cool. We'll get to do some stuff in real time. I need to manage some trades today. So their optimal days to expiration based on their research is 45 days. If you look at and that's for out of the money options, generally around is it one standard? It might be two standard deviations, I think. Anyway, around the like 84% chance of profit, like on let me just pull up MicroStrategy. It's going to be 43 days, but it's going to be good enough. So it's going to be right around here at the 84-ish%. They would probably recommend something right here. Might as well go to 1600. And you'd go 45 days, you'd pick this one, and then that's maximum efficiency for them. Now, I prefer to go weekly, and I'll discuss that. But for now, let's just say you went with this. And what you would attempt to do would be to manage this trade. And so there's two decisions you really have when you're going to close this, because you don't actually want to hold this for 45 days. That is not going to maximize your capital. In general, within the first 2 to 3 weeks, you want to see if you can manage this trade. So you're either going to close it and redeploy this capital somewhere else, or you're going to roll it, which is basically just closing it and opening a new position that would be 45 days out. So 45 days is approximately 6 weeks, right? 6 weeks plus a couple of extra days. So after about 3 weeks, half of 45 is going to be 22 and a half. So after about 3 weeks, if more than half of this value is drained out, if you got paid $6,800 and it's worth more than $3,400, then there's still a lot to collect. So maybe you'll hang on to it a little bit longer. But if there's only $2,000 left, you've already collected more than half in half the time. So do you really want to wait the other half of the time to collect less than half? No, that's not the maximum efficiency we're looking for. So you can maximize your profits a little bit if you, after a couple of weeks or whatever, if you look at this and you say, have I collected more than I should have if it drained out a little bit, equally per week? So if this was 6 weeks, you would expect, what, 1,100 to drain out per week? So after 2 weeks, if $3,000 has dropped out, if this is only worth 3,800, or after 3 weeks, instead of being worth like 3,500, if it's only worth $2,000, then just close it, just buy it back. And now you get your 100 shares of MicroStrategy back. And because let's just say, so 1, 2, 3 weeks. So we would be basically looking at this. So let's go up to the 1,600 strike. This is just an approximation, but if that $6,800 call after 3 weeks is now only worth 2,500, buy that sucker back. Now you have your 100 shares of MicroStrategy that you can go and sell another covered call. So you bought it for 6,800, you buy it back for 25, you pocket the 4,800 as profit, then you go back out to 45 days and you sell the 1,600 again, and you collect 68. You collect more premium. If you don't do it this way, then you're going to collect the $4,000 over the first 3 weeks, and then you're only going to collect $2 grand, 2,500 or whatever it is, over the last 3 weeks. But you'd rather collect $4 grand every 3 weeks than 4 and 2, 4 and 2. So that's the optimal way to manage a trade. Now, that's assuming that the price of MicroStrategy stays at 12.20 the whole time, doesn't move, doesn't go up, doesn't go down. If it goes down, you might be able to roll this in 1 week. But in order to collect more premium, if the price of MicroStrategy rolls down $100, you might have to go down and sell the 1,500 strike. And this might only be worth $6 grand or something here instead of being worth $6 grand up at the 1,600 strike. So the price of the stock moving can also change this. But it would be the same if you're selling a put. Tasty Trade would recommend going out to, let's do 84% again. So let's say the 850. You're only going to be able to collect $2 grand on this though, which I wonder why. I guess the options are a little different. In order to collect that same amount, you would only be able to go down to like the 1030, which is still a 20% discount off the price. Well, let's go to a nice whole number. So the 1050, you could collect $7 grand. But that's only about a 70% chance of profit. This is still out of the money. So anywhere between here and here would be fine. It's just how are you worried about MicroStrategy going down to 950, you know? But regardless of which you pick, the strategy would be the same. So after about 3 weeks, if more than 2,200 is drained out of this, if this is worth 2,200 or less, you know, $2 grand or less, then you just buy it back for cheap, and then you go. Let's just go back to this is a 950. So let's go 1, 2, 1, 2, 3. So the 950 we would have gotten paid, was it 4,400? So if it's only worth 1,600 or less, you just buy it back cheap, close the bad boy out, and then you can go back out to 45 days and get the 4,400 again, or you know, whatever strike you picked. However, for myself, since I only go out a week, and I'm going to switch over to something that I am trading. Mars no good because I still have intrinsic value left in that. All right. So for Riot, I sold the $12 call a week ago. I got paid $18, which is about, what, 1.5% in premium returns. And then I baked, I think the price was probably 11. So I baked $1, basically almost 10% callaway value in here. Unfortunately, the price went down, not up, which, you know, I say unfortunately, but it's fine. It's either up or down, doesn't really matter. And so I collected 16 of the $18 in 4 days. And it's almost 3 days, really, because this is, the market just opened on Thursday. And when I close this tomorrow, that's going to cost me $1 to roll it if I don't let it expire, worthless. And so do I really want to let this sit for almost 2 days to collect $1 when I collected 16 in 3 days, in almost 4 days? You know, $4 a day, and I'm going to let this sit for another day and only collect $1? Doesn't make any sense. So this is the same way. At some point, if you've collected more of the value than the ratio of days left, like on Wednesday, halfway from Friday to next Friday, if more than half of this is drained out, if this is $9 or less, then you're going to want to, come on up. I got to call the dog. Come on. Come on up. Good boy. he has to whine to be allowed on the bed. All right, so you're going to want to manage this in the same way. If more than half of the time is left, excuse me, about half the time is left, but more than half of the value is drained out, then you're going to want to close this. You don't want to lock up $1,000 worth of capital for any length of time, really, just to collect $1. That's not maximum efficiency. So I am going to close this. I paid $2. So I got paid 18. I bought it back for 2, so I collected 16. So that's about 1.5% profit in 3/4 days. And now this 100 shares can be redeployed. And I can look for tomorrow and collect. I'd have to drop. So before I had over, about $1 of callaway value. If I try to get a little greedy with the premium and try to sneak this 1050 in, sure, I can get another 1% in one day, but the callaway value would only be 34 cents. So do I want to risk Riot pumping overnight just to collect $10? And if you think about it, 1% in one day is like 5% for the week. So it's not the worst decision in the world. And if I went to 11 and really, actually, let me think about this. So 33 cents is only about 3% callaway value. But if I prorate that for the week, that would be like 3% times 5. That would be like 15% callaway value prorated out for a whole week. So 1% for one day versus just barely any callaway value. Let's see what else I got. Let me see if I can do one way and one the other way, just for shits and giggles. So HUT has a nickel of premium left, and I've collected $14 in 4 days. So this one's actually not too bad. I can hold this till tomorrow, collect another $4, which compared to the trade price here is like 0.5% in 1 day. So that's not too bad. So I probably will just roll the Riot. So let me see what it looks like for next week and see if I just want to roll to 8 days instead of 7. If I bake $1 worth of premium in here, I can go to the 11 or the 11.5. 11.5 would give me another 1.5% and in premium and 10%, over 10% call away. I think I like that the best. So let's see if we can get a fill at the mid price. And actually, that's only 1.5% for 8 days. So I am kind of I'm being less greedy with the premium. And 0.17, let's try 0.17. There we go. Got a nice fill on that one. All right, so I won't have to roll Riot tomorrow. That is done. But let's look at an example. Oh, HUT did update down to $2. Why is it flipping between 2 and 5? Okay, so maybe the bid-ask spread is between 1 and 3. This could go either way, really. With the premium being 19 to begin with, I don't know that I want to pay $2. Hopefully, I'll just be able to buy this back for $1 tomorrow. Let's look at what I could get. If I drop it all the way down to the 850, I could pick up like 6 cents. But if I go out to next week, at least 80 cents more. I'd have to go to the $9 strike. I can get 2%, a little more than 2% for the week, plus $1 of call away. Yeah, let's do that. Let's do that. So let's try to close this one for 2. If we're lucky, this will fill at the mid price. Otherwise, it's going to tick me off. There we go. All right, so this will be another one. I get my collateral back, go out the next week, and I said I was going to do the $9 one, right? All right, let's try to get a fill for the mid price. If this does not fill in 5, 4, 3, 2, 1, I will replace it. And let's do 0.21. This should fill. Come on. Don't make a liar out of me. They're really going to make me walk it down another penny. Come on, market makers. All right. Ain't nobody got time for that. So let's just smash the bid. Cha-ching. All right. And that's why liquidity is important, because you can get screwed getting in and out of the trade. So it looked like I was going to get $22 for that, but I ended up only getting 20. All right, so here's one that I don't want to roll. You can see that Mara pumped. So right now, Mara is at 1957. Now, since the price is above my strike, this now has some intrinsic value. When you're selling out of the money calls, the entire $53 that I had sold was all extrinsic. That was all just time decay. That was when the price was like 17. But now the price is 1961. So this 97 cents that this is worth, you got to subtract out the 12 cents between 1950 and 1962. So there's 12 cents of intrinsic value and only 85 cents in extrinsic value. So there's actually more extrinsic value now than there was when this started. So I can collect most of this by leaving it until tomorrow. Because if the price is still 1965 at expiration tomorrow, then the price of this option is going to just be like 15 cents. Like if I wait all the way until 3:45 p.m., like right before close, the only value left in this option is going to be the intrinsic value, which is going to be how much over 1950 this is. So I can actually, it looks like I'll be able to collect like 80 cents in one day, which is like 4% in extrinsic value. So this one I do not want to manage early. Some people get nervous, and if I really wanted to make sure that my shares did not get called away, then absolutely, someone could be like, you know what, I want to exercise this call, and if that scared me, I could roll this early. But it doesn't really make sense for me to do that, in my opinion, because if I want to bake another $2 into this, I got to go to the 21.50 or the 22, and I would actually have to pay to roll this, and I'd just rather not. In order to not have to pay, I'd have to like roll to the 21 or the 20.5, which is less call away value than I have now. It's not baking in that 10% call away value that I really like with these Bitcoin mining stocks. So this one I will sit on. I think the 20 is in the same boat. Yeah, well, let's check. So this one is not in the money, but it's close. But all of this is extrinsic value. This has no intrinsic value to it because it's under $20. The price is under $20. It's under the strike price. However, you can also see that the extrinsic value has grown. Look and see what, yeah, so theta is up to 36 cents because all of this, all this value has to drain out by tomorrow. When I sold this, the delta was probably under 0.3. So now you can see as it approaches expiration, delta starts to approach 1. It starts getting bigger and bigger. And somebody had mentioned gamma risk before, and that's gamma risk is what's kind of driving this, because gamma is going to increase as we get closer to expiration, and every time the price of the the price of the share fluctuates like $1, this is going to fluctuate by $1. So this share price will just be like all over the place as the price dips or pumps. So either way, all of this is extrinsic value, and I can collect it in a single day till tomorrow. So I will just sit on this as well. This does not make any sense to manage early, in my opinion. So we managed Riot and Hut because they had like $2 left. So it was less than 10% value was remaining, but there was today and tomorrow, like all day Thursday, all day Friday, was still left. Even if it was just one day, that's 20% of the week. All right, so if you're doing the tasty trade method, you're going to 45 days, you want to manage around the 2 to 3 week mark and see, just check in and see if it's worth keeping that or if it's ready to roll. And if you're selling puts, your decision isn't necessarily whether to roll it, but you can also decide, do I want to be in that stock anymore? If you own the shares, and you just didn't want to trade it anymore, you could just sell them, of course. But selling, let's do Mara. If you're managing a put that you sold, you sold this one, a few weeks go by, and now it's only worth like 20 cents or whatever. And you buy it, you sold it for 38, you bought it back for 20, you pocketed the 18. Actually, that probably doesn't make sense. You want to buy it back for 15 maybe. And you're going to get your $2,000 back. It's a cash secured put, so you're going to get your 1,900 in buying power back. Do you want to sell another cash secured put and collect another 38 cents, or you're like, I don't really like the premium in this anymore, and you go find something else? So managing the trade is also the decision of, do I want to continue to trade this particular asset? And let me just give an example of something that I probably wouldn't trade. So it's not that Apple isn't a good stock. This is a nice chart. I probably wouldn't get into Apple at this point anyway, just because, yes, they will appreciate, but all the disrupting that Apple has done, I think they've already done it. They already disrupted Nokia and all of the regular cell phone manufacturers with the smartphones. And so I'm not really sure who they can disrupt at this point. They couldn't get an electric vehicle off the ground, so they're not disrupting electric vehicles. I think they offer a dividend, so that's bearish to me. It means they can't figure out what to do with all their profits other than come out with a new iPhone and iPad every year. So, but that's not even why. So let's just go out 1 week. I can't even get 1% call away just above it at the money. That's like 1% call away, $1.80, and not even 1% premium. This does not make sense to me. So, if I had 100 shares of Apple, I would sell covered calls against it. No doubt about it. I'm an option seller, but this stock, like if I got $200 to spend, it's not going to be in Apple. That's for damn sure. Not financial advice, but even like selling I guess I could sell a put here. It's almost 1% at the money. Like, still kind of crappy. But that's a sad thing. I'm so spoiled with how much premium you can get on selling covered calls and selling puts that this 1% or like 0.5%, 0.75% or whatever, that's, you know, 0.5% a week still adds up to 26% a year. So that's like insanely better than what you can get in freaking index funds. But yeah, this doesn't make sense to me. I guess if I had 100 shares, I'd probably do the Tasty Trade version, go out here. At least I can go up here and get almost 1% with $10, $12 in call away value, and then just try to manage this trade, I suppose. But this is completely uninteresting to me. So this is just an example of when I decide, you know, when I'm evaluating whether this is worth trading or not. This does not get my blood pumping at all. Even to get 1%, like what was it, 1.5%? That's only $6 in call away value, so like 3% call away, 1.5% here. I mean, I would still do it. If somebody held a gun to my head and was like, "You have to own Apple. Now what are you going to do?" I'm like, "Okay, I'm going to sell covered calls against it." Oh, but that's what I would do with the premium. So if I came out here, collected $130, then I would just go out here, because if the price of these options sucks for a seller, then that means the price of the options is probably good for the buyers. So I would take this $130, go out over a year, go way the hell up to the top of the chart. I'd take that $100 and I'd probably buy 2 of these leaps. And then I would probably just keep doing that every week. And then over the course of the next 6 months, what is that, 20-something weeks, I'd have 40 of these damn things, just dollar cost averaging into it. And then, you know, I guess if the price pumps or something, then maybe these would be worth something. But I just wouldn't do it, period. But if I had to do it, I was just determined to do it. Like maybe you want to hold 100 shares of Apple because I think, right, they have dividends? I don't know if Robinhood used to be better about listing dividends. Yeah, dividend yield. Okay, so if you're like, okay, I can hold the stock and I can collect a dividend, and then what else can I do to generate some yield? All right, I can sell covered calls against it. Maybe that makes some sense in someone's universe. That's fine. Not for me, but I would still do that, and then I would probably just buy those leaps or something. But then again, if you buy a share every other week, at least you'll be getting dividends on that. I can see an argument being made either way, if you're going to sell covered calls and buy shares, or sell covered calls and buy options, because you're not going to get paid dividends on options. But yeah, if I absolutely had to do this, that's what I would do. But bottom line is I just wouldn't. Even Tesla's kind of annoying me with the premium, so which is roughly the same price as Apple, and they don't offer a dividend. They actually believe in themselves. But if I was going to go out a week, 1%, you can at least go to the 82.50. That's about $9 in call away. So that's like 4.5% call away and 1% for the week. It's not terrible, but I'd like to be able to at least get to like this 185 and still collect the 1%. But I'm going to start doing the same thing with Tesla. And when I pocket this premium, what did I go out to? I think I have I went out to a different strike in the small account than I did in my main account. But I have the January 2025, so what is it, about 7 months, 8 months? I got the January 2025 600 calls. So if I got paid $180, $150, whatever, I would go out here, or I will continue to go out here, go way up into the nosebleed section, and just keep grabbing these. I can grab a couple of these per week selling Tesla covered calls. So if the premium is not good for the seller, the premium is probably pretty good for the buyer. So I'm an option seller. I'm going to sell covered calls and puts no matter what. But if the premium is really good, I may be more likely to buy shares. That way I don't have to pay the exorbitant premium. If selling is good, buying them is probably bad. I did buy some Tesla leaps and some even MicroStrategy leaps, though. I needed that. I felt like I really needed that MicroStrategy upside protection. So I will probably be purchasing leaps, and then if the price pumps, then I will just sell them and buy the shares instead. So that's a little bit of tweaking that I did. So I hope this makes sense. Maximum efficiency for selling options is going to be somewhere under 45 days. I prefer 1 week. And then maximum efficiency on managing the trade is any time the value that you have left in that option does not justify holding it any longer. So if half the time is gone and more than half of the value is gone, it's time to roll that trade. That's the bottom line. All right. I hope that that helps, and leave it there. Be good, y'all.